Hello, everyone, and welcome to the 2025 Fragasso Portfolio Management Discussion. I'm Daniel Dingus, President of Fragasso Financial Advisors, and I'm excited to be your moderator today. Before we dive into the markets, I'd like to just take a moment to highlight what makes Fragasso unique and how we continue to grow. We are an independent, employee-owned firm serving over 2,000 clients across 44 states with a team of nearly 45 salaried professionals. This year marks our 53rd year in the business, and today we're proud to manage more than $2.6 billion in assets on behalf of our clients. What sets Fragasso apart is the strength of our in-house portfolio management team. They work hand in hand with your financial advisor, always acting as your advocate. And every decision we make is guided through our larger investment committee, from research and analysis to financial planning to ultimately to portfolio implementation. As we look ahead to 2025, there are a few key themes that will shape today's conversation. Building resilience in a changing economy, finding opportunity in global diversification, rethinking bonds in a higher interest rate world. And I think this is a big one, separating political noise from long-term strategy. These are the ideas we'll unpack today, but our focus is always on you, your goals, your plan, your financial well-being. Now, let's get to our two panelists tonight. First, Michael Godwin, our Chief Investment Officer. Michael is responsible for reviewing, monitoring, and guiding the asset allocation strategies and the big picture themes that drive our clients' portfolios. He brings a wealth of institutional experience to Fragasso and has been leading our portfolio management efforts here in Pittsburgh for more than a decade. Michael is also a chartered financial analyst, or CFA. Next up, Jim Senegal, our senior investment analyst. Jim focuses on researching individual stocks, overseeing many of our large company strategies. And before joining Fragasso, Jim spent over 11 years as an equity research analyst at Morningstar in Chicago. His expertise has been featured on national news outlets, and his work has taken him pretty much around the globe to many, many countries. So with that, I want to dive right in, and I'll start with you, Michael. I think we always kind of begin these with a little bit of a recap of what's happened in 2025. Can you walk us through what's happened and maybe a little bit of what we can expect moving forward?
Sure. Thanks, Dan, and thanks everybody for joining. It really means a lot to us, and hopefully you can find this informative. So I don't think, Dan, you could start by talking about a recap of 2025 without talking about what happened in the first quarter. The markets peaked on February 19th of this year before starting a 2-month decline. So from February 19th to the end of that month, the markets lost 5.5%. And the decline continued into March. March actually ended as the worst month in the market since September of 2022. In that month, we lost 5.7% or so. And this all happened before Liberation Day, which was, as we all know, on April 2nd. In the 4 trading days after Liberation Day, the markets lost 12% more. So all in less than 2 months, the markets lost more than 19%. But as fast as the markets declined, a rebound ensued. And you can see here that in less than 3 months, the market erased all its losses and hit new all-time highs. And over the past couple of months, Dan, I've been asked by 3 different clients on whether it's smart to put money to work or to invest once the market hits new highs. And that got me to thinking, because that's I understand that sentiment. I understand that rationale, right? Because if you start investing or you want to put money to work once the market hits a new high, the next logical move you think in the markets is going to be down, right? That's really often not the case. Take this year, for example. This year alone, the market has hit 22 new all-time highs. And we're only, midway through September. And last year, I know we all know last year was a pretty good year, but Dan, I'll throw this to you. Do you know how many all-time highs the market hit last year?
It's a pretty good year. I'm assuming a few.
Yeah, the market made 57 all-time highs last year.
Wow.
So you mentioned I've been here for a decade. I've been doing this for a long time now, and timing the markets is hard. It's not easy to do. I think though there is, if I when I answer those clients' questions, I said there's really no better time to put money to work than right now. Even if the markets are richly valued, which we'll get into a little bit later, even though there's a litany of geopolitical issues that you mentioned earlier on in the introductions, if you sit out the markets, or if you want to pull money out of the markets because the market's expensive and wait for a better opportunity to get in, you're often going to do yourself a disservice and trying to reach your financial goals and objectives. Now, I'm going to not so eloquently transition to a slightly different topic here, but I think this is a very interesting slide, and it speaks to the diversification benefits that need to be had within the US market. We often talk about diversifying to the overseas markets, but it's also going to be, I think, important going forward to make sure you have diversification within the US stock market. So the Magnificent Seven have dominated returns and headlines for at least 5 to 7 years now. And the Magnificent Seven are just 7 stocks within the S&P 500. It's Facebook, Amazon, Nvidia, Apple, Google, Microsoft, and Tesla. Those 7 stocks, Dan, in Q1 were the significant drivers of the negative market returns. We can see here that an equal weighted basket of S&P 500 stocks, so every stock weighted the same, was actually down a fraction of a percent in Q1. But it was those 7 names that were down almost 15% there. Now you can see in Q2, those 7 names had a really good rebound there. But the point of this chart, I think, is you're getting a lot of volatility out of those 7 names. And it's not always to the upside. In fact, a couple of those names are still down on the year, even though the S&P 500 is up 12 or 13% or so. So I do think that it's important to maintain diversification here. And it also goes to show you that, there's been a lot of storylines so far in 2025. And I don't think the last 3 months of the year are going to be any quieter.
Well, I think that's well said. And we're going to come back a little bit to the Magnificent Seven as well. But I'd like to go to the international markets. Jim, I've asked you this question for years and years. And we're finally at a point where we can point to some good news in international markets. Despite the headlines, despite the tariffs, what is the outlook for international stocks, and what's driven the returns this year?
Yeah, for once, it's a pleasure to answer this question. International stocks are finally having a great run this year. So far, both developed markets and emerging markets have about doubled the return of the S&P 500 so far this year. And the S&P has done well. International has done twice as well. And there are 3 good reasons why international stocks have performed so well this year. The first is that we have a lot of policy uncertainty in the US. We have changes in fiscal policy. We have a big, beautiful bill. It's likely to increase our national debt over time, which is already at all-time highs. Debt and deficits are something that have been concerning as long as I can remember. And this is another step towards making them higher, not lower. Over the past few years, we've also had some of the highest inflation that we've seen since the 1970s. It's been coming down so far this year. But on the monetary policy front, we're starting to see tension between the executive branch and the Federal Reserve. So uncertainties in fiscal policy, uncertainties in monetary policy, that's caused weakness in the dollar. And so that alone has been a big tailwind for international stocks. If we look at the returns, about half of the returns of international this year have come from currency movements, weakness in the dollar, strength in foreign currency. The second, more positively, we've actually seen some improvements in markets outside of the United States. Europe has engaged on a program of fiscal stimulus. Europe has been slow growing for some time. Investors are hoping that increased spending in Europe will help boost their economy. China There's been a lot of worries around China, but they've actually reported some decent data, at least in the first half of the year. So we've had good economic news internationally, which has helped as well. And then third, something we've mentioned in years past, valuations have been better outside the US for some time. As Michael likes to point out, valuation is not everything, but you are generally paying less for every dollar of earnings when you buy foreign stocks, at least for the past few years. So, it's not the only factor, but when you have additional catalysts like the maybe weakness, uncertainty in the US and strength in international, you get an extra boost from valuation. So looking forward, we think there are a few reasons to stay invested in international stocks. First is that these performance cycles tend to be pretty long. We've had 9 months so far. Over the course of history, these performance swings between the US and international have averaged about 8 years. So could be some room to run as far as that goes. But really, the main reason we hold such a significant weighting is that they are such great diversifiers from US equities. You get growth similar to what you would get in US equities. Europe has some great drug companies. Taiwan and China have very good tech companies. And you're getting paid in currencies outside of the dollar. So when you're looking to hedge your US exposure, we think these international equities are much better than something like gold because you're getting the growth at the same time you're diversifying outside of the dollar.
Well, I guess to your point on the gold, international stocks also pay dividends usually, and usually more significant than the US, correct, Jim?
Yeah, exactly. You get a high dividend yield. So that additional income is going to be a significant percentage of your return over time.
Good. Michael, Jim raised a point on the debt, and that's obviously a significant question. We get it a lot from clients this first half of the year, certainly around obviously the US government. I guess my question to you is, how big of an issue is this? And what are the implications for the portfolio, and maybe even more specifically for fixed income, which are so much interest rate sensitive?
Yeah, it's a great question, and I got the question a lot around the passage of the big beautiful bill, but it's certainly pertinent right now, without a doubt. This chart I wanted to show, it's a busy chart, so I apologize for that, but it shows that the U.S. government last year spent more than $1 trillion in interest expense alone.
Wow.
Since COVID, we have simply turbocharged how much money is in our system. And not surprisingly, our budget has ballooned, and inflation followed suit in the years after COVID. Now, you mentioned, Dan, that has been talked about for a long time. It's been talked about as a problem for more than 50 years. And I can promise you this, in 50 years' time, we'll continue to be talking about the debt. But for it to become a problem in the markets, I think two things need to happen. One, I think you'd see the level of longer-term interest rates ratchet higher. And also, I think you would see inflation expectations also remain elevated. Not inflation expectations because of tariffs, but inflation expectations because of the level of debt. And we're not really seeing that play out in the markets right now. So having a look at this chart, this is a chart of the US 10-year interest rate. Okay, we all know that rates went up pretty dramatically in 2022 when the Federal Reserve began hiking rates because of an inflation problem. But you can see on the right-hand side of the chart that interest rates have remained pretty much range-bound over the past couple of years and have trended a little bit lower. If this were a problem in the markets, we would expect that rate to go up quite a bit. And the reason is because investors would demand to be paid more in yield if the government debt was deemed to be very, very risky. So we're not quite seeing that play out yet. The same thing is true with inflation expectations. So this is a chart, Dan, of inflation expectations in 5 years' time. So when all the noise surrounding tariffs kind of dissipate. And you can see that it's been pretty muted. Expectations are for inflation to be a little bit over 2%. Again, if that were a problem in the markets, I think we would see that likely to be higher. I am not saying, though, that the level of debt we have right now isn't an economic problem or isn't a problem for our kids or grandkids one day. I think that you can certainly make the argument that it will be. But I'm talking about from a market standpoint right now, it isn't quite a problem yet. Now, transitioning into what this means for bonds and fixed income, I think was part of your question, Dan.
Yeah.
We absolutely think that bonds and traditional bonds have an important place in many and most portfolios. The outlook for bonds today is certainly a lot better than it was even 2 years ago. Okay. The average yield on a broad-based bond index, we call it the aggregate bond index. It's like the S&P 500 of the bond world. That's 4.3%. Okay. That starting yield, historically speaking, has generally given you a pretty good idea of what you can return in your traditional fixed income over the next 5 to 7 year period or so. So 4.3%. It's not a great return. It's not a terrible return. It's kind of adequate. But we do believe that it is very important to continue to think outside of the box when it comes to constructing your portfolio, and particularly in constructing the way you allocate to fixed income. And I'm going to get into that right now. So over the past century or so, we have seen an evolution in portfolio management in the financial markets. From investing in government bonds and stocks in the 50s and 60s to the first retail mutual fund that was introduced in the 1970s, the standard 60-40 portfolio first came to light in about the 1980s. And the first ETF, or exchange traded fund, was launched in the 1990s. We have seen portfolio management become more diverse over the years and more democratized. And I think the next iteration of diversification and democratization in portfolio management, Dan, comes from the alternative space. Now, I think a lot of people on the call are already familiar with this story, but it does bear repeating. So alternatives are simply any types of investments that are not really stocks or traditional bonds. It can be investments in private equity, infrastructure, private credit, real estate, just to name a few. These are investments that large pensions, endowments, sovereign wealth funds have been investing in for years. And now high net worth retail investors have access to invest in them as well. We think that adding these types of investments to a well-balanced stock and bond portfolio can increase the risk return metrics of a traditional bond portfolio. So tying this back to fixed income, Dan, most of the alternative investments that we invest in at Fragasso are sourced from the traditional fixed income markets. That's because a lot of these investments pay a pretty sizable income stream, and they can also help tamper down volatility. But the one thing I really wanted to point out here is, in this alternative space, it is absolutely imperative that you not only select the right type of investment you want to invest in, but also select the right manager for that investment. Because the differences in returns from like the top quartile manager to the bottom quartile manager can be extreme in this space. And that's really why, Jim and I and my team, we spend a lot of our time researching the types of investments and the managers in the alternative space, because it can be very, very critical to portfolio returns to make sure we get that right. So long story short, Dan, I think these should play a role in many portfolios. And I think it's going to be very important to continue to think about how they really play a part in our clients' portfolios.
That's well said. And you brought up an interesting point, Mike, where you said, hey, the broad-based bond index, the aggregate bond index, is yielding roughly four and change. But it wasn't so long ago during COVID. I believe that was pushing a yield of what, under 1% at one point?
Yeah, if you go back real quick to my 10-year bond chart that I had up there, you could see at the bottom there, Dan, the nadir of that, that the 10-year was yielding just under 1%. So the bond market looks a lot better today than it certainly did then. But again, 4.3%, it's fine. Factor in inflation, your real return is going to be lower. This is one of the reasons why we want to continue to think outside of the box and include other assets that can do very, very well almost no matter what the economic environment is.
Good. Good. Well, they certainly complement bonds and stocks well, and I appreciate the effort and the research that goes into that process. Jim, I'm going to take it back to you and moving on a little bit from the markets and economics, but we need to talk about AI. It's a question that we get constantly from clients. We've received a question come through already on AI. It's been a big driver of the markets, but at the same time, is there a bubble? But I'd like you to package this answer in a way that demonstrates what opportunities are there and what risks, because the spending on AI is really shaping the markets and the economy in the US and potentially abroad.
Yeah, I liked how you framed the question. We talk a lot about returns in the investment world, but really our primary job in portfolio management is managing risk. So I'll start with the risks and maybe circle back and address that at the end. So first, as we talked about earlier, the market in the U.S. is highly concentrated. So going back to that chart, Michael, of the Magnificent Seven, they make about 1/3 of total market cap now. So you can see 2016, around 10%. Now about 1/3 is accounted for by just those 7 companies. So the market is extremely concentrated, and a lot of the market returns are coming from these same stocks. So kind of as the Magnificent Seven goes, the S&P 500 goes right now. Second, these companies are relatively expensive. NVIDIA, for instance, has a price to earnings ratio of around 50. You invert that, about a 2% earnings yield. Takes a lot of growth to make a 2% earnings yield into a good investment. So a lot of growth, a lot of optimism are priced in. We're generally a little cautious of expensive stocks. Third, we are having a huge boom in spending. People worry about boom bust cycles. And looking at the next chart, you can see the growth in AI investment over time. We're getting about $100 billion from just 4 companies alone this year in AI CapEx. And if you look at the Mag 7, that's about $300 billion. We also have the secondary impacts of that. The demand for energy, for instance, is skyrocketing as a result of how much power these data centers and these hyperscalers require to do the calculations. If you look up how much energy it takes to ask a question of ChatGPT, it's really remarkable. So all of this has drawn comparisons to the late 90s tech bubble, for those of us that remember that. People are worried that these companies are going to end up like past high flyers, the Nortels, the Lucents, the WorldComs of the world that were once at the top of the world, top of the market, and then in some cases went completely out of business. The good news is that for now, we don't think that's the case because there are some significant differences between what we're seeing right now and what we saw in the late 90s. First, unlike then, capacity for AI is still in short supply. We're seeing companies right now signing leases for space that is not even built yet. So in contrast, when we look at some of the fiber cables that were laid in the late 90s, they were completely dark, were not used at all until about 15 years later in the 2010. So the scale of overbuilding, we can't keep up with the demand now, whereas they were building supply to keep up with demand that wouldn't manifest for another 15, 20 years. So big difference, especially in the near term. Second, these companies that are spending are cash rich and very profitable. It would be a different story if these companies were borrowing billions of dollars to buy chips. A lot of the companies in the late 90s were borrowing to build out this cable. That's not the case. As we learned in 2008, leverage amplifies the downside, and there's just not much leverage at all with the Magnificent Seven. I think more importantly, we're still in the very early stages here. Productivity growth as a result of the internet expanded by more than 50% after the late 90s. Despite the help you get from ChatGPT, other large language models, that has not even moved the needle on overall productivity yet. So very early stages. Just another comparison. ChatGPT was released in November 2022. So we're not even 3 years out yet. The first web browser, Mosaic, came out in 1993. So just another kind of .com comparison there. we may only be in 1996 if we compare AI to the internet. So very early stages. That makes us pretty optimistic about what we're going to see from these companies and the overall economy over the next 5, 10 years or even more. This is arguably an even bigger advancement than we saw 25, 30 years ago. So turning back to managing risk, all that said, even with the concentration in the index, the average portfolio definitely does not have all its eggs in one basket. The reasons for that are a couple. One, we still don't know how profitable AI will be. Google, Facebook, for now, they sell ads. Selling AI is a completely different business, and it's still in the very early stages. Hard to tell who the winners will be long term. So it's good to stay diversified, stay cautious. And for that reason, portfolios in general are well diversified. Even given the concentration in the Magnificent Seven, the average portfolio right now has 85% of its holdings outside the Magnificent Seven, whether it's bonds, whether it's alternatives, whether it's international stocks. We are by no means overly concentrated in these stocks. So good to have enough in the portfolio to benefit from the boom, but also, our main job is controlling risk, and that's something we definitely are keeping an eye on.
Well, thank you for giving us a little perspective on AI and the pros and cons of it. I think this is going to play out for quite some time in our industry and the economy as a whole. Michael, I want to bring it all back together with you, if you might. Can you give the audience a general outlook on what we might be able to expect for the last few months of the year and into 2026?
Sure thing, Dan. So the first thing I want to say, Dan, and you kind of brought this up in your opening remarks, is that we can't and we really won't trade around geopolitical issues, right? Yes, we pay attention to the tariff news. We pay attention to the China summit that happened a few weeks ago with China, India, Russia, and Korea. But they aren't materially influencing our decisions. And that's simply because we can't tell you really what's going to happen sometimes. Right? Are tariffs on? Are they off? Is the Supreme Court going to strike them down as unconstitutional? Is Donald Trump going to have bilateral talks with a couple of nations? We just don't know the answers to that. They can help influence a little bit of a decision, but we don't materially trade around geopolitical issues. So having said that, Dan, as we talk about the outlook for the stock market going forward, I want to go over a quick reminder or refresher about how stocks can go up. There's really only two ways for stocks to go up over the long haul. One is if earnings go up. So take Apple, for example. If Apple last year earned $100 and then this year they earned $110, all else equal, Apple should go up by about 10%. The other way stocks can go up is through changes in valuations. So are stocks getting more or less expensive? What is the price people are paying for that earnings growth? That's the other way stocks can go up. So as we look at the S&P 500 so far this year, and I made this chart a couple weeks ago, so the mark's a little higher than it was when I made this, but at that point, the S&P 500 was up 10% on the year. 6.5% came from earnings growth, which is really what you want to see and what you want to see over the long haul for sure. The other 3.5% on the right has come from a change in valuations, meaning stocks have gotten a little bit more expensive this year. So earnings and valuations, that's going to be what I'm going to be talking about a little bit here as we go on. Now, as it pertains to what we are focusing on here at Fragasso from an economic and a data standpoint, Dan, it's really three things right now. It's one, earnings, as you can see there. Secondly, profit margins to an extent. And the third thing is going to be the employment situation here. Okay. We just wrapped up earnings season a few weeks ago, and you can see in the top panel here, earnings for companies have been really, really good on aggregate. We continue to grow our earnings at a healthy and steady clip, even despite some of the geopolitical noise that has happened so far in 2025. And in the bottom chart, that's our profit margins. They aren't at all-time highs, but they are certainly still very, very elevated. So from a company standpoint, Dan, things look pretty good. Now, on the employment side of things, the employment scenario looks, I think, still pretty good for the most part. Yes, we are off the lows where the unemployment rate touched about 3% a couple of years ago and has ratcheted higher to 4.2% today. But in the grand scheme of things, from a historical context, it's still pretty low, which is good. Now, there are some cracks that are forming in the unemployment market, and that's definitely something we are paying attention to. But overall, we think the employment situation looks pretty good, although some situations where we are monitoring if it's going to progress and get a little bit worse. All in, I think it looks okay. Here's where I think we need to be a little bit cautious on. We talked about valuations, Jim did a moment ago. I'm going to expand on it a little bit. This is the S&P 500 price to earnings ratio. Jim mentioned this, but this is the most common valuation metric that is used in our industry. That blue line there is the average valuation metric for the S&P 500 over the past 20 years. Very, very simplistically, and I would never invest on this data metric alone, if stocks are under that blue line, that signals that they are cheap relative to their 20-year average. If stocks are above that blue line, that simply signals that stocks are more expensive than their 20-year average. And you can see right now on the far right, stocks are a little bit expensive compared to history. Now, there are a whole host of reasons, some even justifiable, as to why stocks are expensive today. But suffice it to say, I think stocks are obviously a little bit expensive than what their 20-year average is. The important thing to note is, over the long haul, Dan, it is earnings that matter the most. Valuations or changes in valuations tend to be the noise over the long haul. This chart here shows the S&P 500 going all the way back to 1980. It's the S&P 500 in white juxtaposed with the S&P 500 company earnings in blue. And you can see how closely those track one another over the long haul. So what does this mean going forward? I think we can have a situation where earnings can still be very solid. Wall Street analysts expect earnings growth of the S&P 500 to be about 10% or so a year over the next couple of years. But I do think we're going to find ourselves in a situation where valuations need to compress and come down. And when that happens, that's simply going to weigh on returns over the long haul. So you're going to have a situation where I think stock returns can still be very positive, but I just don't think they're going to be in the realm of what we've come to expect or come to seen over the past few years in the markets. So all in, still pretty good over the long haul, I think. Anything else I should touch upon in the outlook, Dan, before I jump into the takeaways?
No, I think obviously you're spending the time on the earnings and the unemployment picture. I think those are the two key factors. Why don't you touch upon those and some of the key takeaways that our audiences can probably summarize a little bit from?
Yeah, I like to do this, just kind of sum up what Jim and I have talked about over the past 35 or 40 minutes or so. From a very high level, I started off by talking about diversification and diversification within the U.S. markets. I think that's going to be important. We think the AI stocks are really, really great. As Jim mentioned, they are relatively expensive. So it's going to be important to make sure you diversify away from that. I also talked about how markets are hitting new all-time highs more consistently than probably most investors think about. So avoid market timing. Try to stay persistently in the markets while you can. Jim talked about, I don't think this is a shock, but we're going to probably expect a lot more geopolitical volatility as we even head into 2026. But it's also important to diversify your assets overseas, not because you get exposure to a whole host of different types of stocks, but you also get to diversify your currency risk, which has been imperative so far in 2025. I discussed, obviously, the debt quite a bit. Without a doubt, the debt levels are concerning. Inflation hasn't spiked yet. Interest rates haven't spiked yet because of the debt, but that is something we should monitor and all investors should monitor over the long haul. We do think it's important to own bonds and portfolios, but also to think outside of the box and own some alternative investments if it makes sense for your situation. Jim talked about AI. This is obviously going to be the big story, I think, in the decades ahead. We have seen a tremendous amount of spending in the AI infrastructure landscape. This is probably not going to stop. We are probably still in the early innings of that. And we're going to see it be very, very broad-based across companies, big and small, throughout the US in terms of the amount of productivity gains we can gain from the usage of AI. And lastly, I just touched upon, I think stocks really are the key investment piece in any portfolio for the long run. Earnings are probably going to be very, very good for US stocks and international stocks. Returns are likely going to be compressed to an extent because valuations are pretty elevated. But nevertheless, you still want to be invested in the US stock market and to a lesser extent, the international stock market for the long haul. And I mentioned, Dan, the two big economic data points that all investors, I think, are going to need to be cognizant of are the earnings growth metrics of the S&P 500, and certainly continue to pay attention to the jobless claims and the unemployment situation in America.
Well, we've received a couple of questions in the queue, but I think it's probably best that we take those offline, and Mike and Jim and the rest of the team can work with the advisors and get those answers back to the clients. I want to be cognizant of time here, but this concludes our 2025 portfolio management discussion. I think in a world shaped by geopolitical risks, advances in AI that you mentioned, Jim, shifting markets, I think there was a common theme here, and it's our focus remains clear. It's a disciplined process aligned with your long-term objectives. I want to thank you, Jim and Mike, our panelists, did an amazing job. As always, our marketing team, thank you guys for putting this together, and the entire team at Fragasso for making today possible. And most of all, I want to thank our clients for your continued trust and confidence. Thank you all.